The Rebel Capitalist Show.
Rick, what about uranium? You know, we had in our first conversation, I think you said that was a when question. It wasn't an if question. And since that time, it's gone up a bit. I don't know how much though. I remember back in March, you know, I bought everything I could as far as the commodities, which included uranium. And I know what I bought has gone up, maybe doubled or something like that. But I don't know where it's gone since we've spoken. So what are your thoughts on uranium?
The uranium juniors, the small cap uranium stocks, are ahead of themselves. They've doubled, tripled, and they've doubled or tripled on a very, very small move in the spot market from sort of 24, 25 to 28, 29.
Yeah.
The junior uranium stocks are clearly ahead of themselves, as is evidenced by the fact that they're all issuing stock as fast as they can to raise money. They figure the money's worth more than their paper, which is always a bad sign. The uranium price is illusory. You see the spot market, which is about 25% of volumes. The contract market, which is very opaque, is beginning to firm fairly substantially now. So you're seeing short-term transactions take place in the sort of $28, $29 range. You're seeing term contracts take place in the 47, 48, 49, 50 range.
Oh, wow. Okay.
So the uranium market is firming right in front of our eyes. It isn't firming fast enough to justify the increase in share prices among the narrative-driven juniors. But the circumstance that we described on your show is absolutely taking place. You know how you said that you can simplify it in terms of debt to GDP? You can simplify uranium too. If you're American, if you look in the US market, uranium is about 15% of total electricity supply, 20% of baseload supply. And in the next 5 or 6 years, there's no substitute for it. You just can't. Solar is not baseload. Wind is not baseload, you know? So either the price of uranium goes up to the price that allows the industry to earn a reasonable return on capital employed and their cost of capital, or the lights go out. Those are the two choices.
Yeah, right.
The International Energy Agency suggests that the fully loaded cost to produce a pound of uranium worldwide, I don't just mean cash cost, I mean fully loaded, between 55 and 60 bucks a pound. So either the price of uranium basically doubles, or the lights go out. And so your readers need to ask themselves which of those two circumstances they think is most likely.
Yeah, exactly. And you know what I find interesting is whenever I talk to guys like yourself that are pros and have been in the business for, especially commodities, for many, many decades, you notice that they talk about the demand side, but they really get focused on the supply side. And what's interesting is when I talk to amateurs, they seem to get just hyper focused on demand and almost ignore the supply components. Is that something that you see as well? And why do you think that is?
It isn't something that I'd thought about it, but I suspect if you're focused on the demand side, what you're focused on is trading. What you find in commodities is because they're so capital intensive and so cyclical that you need to focus more on the supply side because the supply shortfall can't be changed quickly. You know, if, as an example, the price of bread rose, a bakery'd put on a third shift. You know,
Right.
they'd buy more milk, they'd buy more butter, they'd buy more flour, they'd buy more salt, and they'd kick out a whole bunch more bread. And they could respond to the pricing signal by increasing supply. Try and permit a new uranium mine. Never mind finance it and build it. In terms of uranium, the demand doesn't have to increase at all because the price that we pay for uranium isn't sufficient to maintain supply. And when you balance supply and demand by reducing supply and the market firms, the market way overshoots because the industry can't increase production fast enough. The other thing that surprises people about commodities is the insane utility offered by commodities. As an example, the budget to produce electricity in a nuclear power plant may be 6%, 7%, 8%, the price of the fuel. After the depreciation of the building, after permitting, after the lawyers, all that kind of stuff. So if the price of uranium doubles, it has absolutely no near-term impact on demand. because so much utility, or rather so much money, is generated from a small amount of product.
Right.
Similarly, as an example, in platinum, it takes maybe $150 worth of platinum or palladium to put a catalytic converter in place to sell a $60,000 or $70,000 car. If the price of the commodity doubled for the next 5 years, it would have absolutely no impact on demand. So the suggestion that you have is to look at the supply side, because if you aren't able to maintain supply, the price rises, and the price can rise for a long time without impacting demand at all.
Yeah, even if demand is going down.
Correct.
I mean, you could have demand go down and everyone's like, oh my gosh, the price is going to tank because they completely ignore the supply side. But the supply is going down faster than demand.
Right.
You still have the same type of imbalance there. And especially to your point in a commodity, that to get more of the commodity, even if we need it desperately right now, it ain't going to happen for 5 years, for 10 years, something like that.
Yep.
Yeah, maybe it's because we just live in a digital age where it's like, Rick, let's throw up a website. Oh, yeah, we'll just put it up in 10 seconds. And people just assume that it's like that with
I think what happened in commodities is that we invested so aggressively in the means of production in the 60s, 70s, and the first half of the decade of the 80s that we set up a supply surplus that we've been living on ever since. Okay. Our assumption throughout the species really is that we have very, very, very ample supplies. And we do. Technology will allow the real price of commodities to fall over time for a very long time. But there can be hiccups in that wonderful scenario that last up to 20 years. And those hiccups can be painful for those who didn't prepare and very pleasant for those who did.
Yeah. Okay, so you talked about the paper price of uranium compared to the
spot price. Yeah,
the spot price. And the question that I always get in the comments or the back and forth, the dialogue, is the price of silver.
Yep.
And the price of gold. But I think recently it's really been silver because of all the Wall Street bets, the Reddit forum with GameStop and whatnot. So what's your position on, is the silver price manipulated by the banksters in the options market? Is that even possible with the way the futures contracts are set up? Or is there always going to be kind of an equilibrium over the long term because of the market dynamics in play? Or what's your read on that?
Well, I don't think your question's an or question. I don't think manipulation is possible in the very long term. But I believe that all markets are manipulated in the short term. And in the short term, the silver market, because of its structure, is uniquely easy to manipulate. If you have a market where the futures market, as an example, trades 200 to 250 times the amount of silver available for good delivery in a day,
right,
not in a week or a month. I mean, the COMEX can trade 250 times the good delivery availability every day in the futures market. So I don't want to make any allegations. So let's just do a suppose. Let's suppose that the Bank of Rick decided to screw with the silver market. The Bank of Rick could layer in a bunch of futures trades, fairly highly leveraged futures trades, 90-day settlement, 120-day settlement, 180-day settlement, 2-year settlement. And nominally, at least, the futures market trades off the physical market. The Bank of Rick, having put these, let's say, short positions.
So you're selling those contracts into the market. Yeah. When you say short in the commodities or futures, people think stocks. So they think you're like borrowing stocks and then selling them. But with the futures, there's an expiration and there's different variables at play.
Correct. So maybe buying puts, maybe selling above market calls, and doing that by posting margin, and then borrowing $20 million worth of silver, physical silver, and selling that all at once, late at night, when there aren't very many bidders. Obviously, an action that you don't go into to maximize the value of the silver you sold, but rather to provide the maximum downside pressure that you could on the physical price to impact the futures.
Right.
Then you settle out your shorts and call it a day. I remember way back in the day, George, in the 70s, when the silver market was manipulated up. Manipulators always do what's easiest. So if there's an upside bias in the market, they'll run the trade backwards. They'll go long the futures and they'll buy physical silver late at night when there's no sellers around. You've seen that the U.S. 10-year Treasury market, the deepest securities market in the world, can be liquidated. The LIBOR market can be manipulated. The mortgage-backed securities market can be manipulated. The idea that you wouldn't manipulate a market that is as disjointed as silver, given the disproportionate trading volume in the futures rather than the physicals market, would be naive.
Right.
It would be really naive. I never believed that the kids, as I call them, the young people, the Reddit crowd, the Wall Street bets crowd, could impact a market as big as silver. When they moved over from GameStop, which had an infinitesimal market capitalization, to the silver market, I thought, boy, these kids are going to get spanked. I didn't understand that the amount of physical silver that they were willing to buy or their impact in the futures market could be such that they could create tightness in the silver market. But they've actually done that. Certainly your coin dealer friends will tell you that retail denominations in physical silver are sold out. I mean, you can get them by paying a $15 an ounce premium, but that's a rather ugly premium, on a $25 ticket. For a long time, although there was a shortage of material available in the retail market, at Sprott, and I think we may have been the largest buyers of physical silver in the world in the last 12 months for our trusts, we were able to get wholesale quantities of silver in wholesale denominations, institutional denominations, with no trouble at all.
I see. So it's just smaller, right?
A couple things happened. The demand for retail product outpaced supply at the same time that COVID shut down the mints and the refiners.
Yeah.
The guys who take 1,000-ounce product and re-refine it into 1-ounce product. So we had sort of a perfect storm there. That being said, there's tightness. We're still able to get silver ourselves, but it isn't as easy as it once was.